But this week we'll be looking at some new work. Okay. So let's have a look at the overview of Unit 2, just to recap what this unit is about. So in this unit, we looked at the objective of IAS 16, which is how to account for property, plant, and equipment. And then we looked at the scope of IAS 16, and we also looked at some definitions. We had a look at the recognition criteria last week and how to measure PPE at recognition using the initial measurement. So remember, in our practical, we had a question where we needed to decide what to include. Should we include delivery costs? Should we include engineer advice for installation? So all of that determines what we are going to initially measure our property, plant, and equipment at. Then we can look at some elements of cost and measurement after recognition, such as subsequent measurement. Do we have an impairment? Do we have depreciation? Do we have a revaluation? And the two models we are going to look at are the cost model and the revaluation model. So the revaluation model will be done next week. Okay. Please can you guys confirm if you can hear me? Because someone has said no, they can't. Can you guys hear me? Okay, I see some thumbs up, so I'm assuming you can hear me. Okay, so then we also looked at depreciation, how to process depreciation. And we looked at we're going to look at subsequent expenditure and derecognition and presentation and disclosure today. Okay. So let's just recap what we did last week. So last week we looked at the definition of property, plant, and equipment, and we looked at the recognition criteria. So we identified when items of PPE can be recognized in the financial statements. So here, it's not that we just have to meet the definition of property, plant, and equipment. We also need to make sure that the recognition criteria is met. Then we looked at how to recognize significant parts, and we looked at how to apply the component approach. And then we looked at initial measurements. We looked at how to account for property, plant, and equipment at acquisition date. So we looked at the initial cost of PPE, what to include, what to exclude. And then we also looked at different ways of acquisition. So we looked at if the PPE was acquired by way of cash or cash equivalents, or perhaps it was acquired via an asset exchange. Then we also looked at subsequent measurement. We're using the cost model, and we looked at depreciation and impairments. So what are we going to do today? So today we're looking at part 2 of Unit 2. So here we're going to continue with subsequent expenditure, and we're going to account for subsequent costs. We're going to capitalize subsequent costs, such as improvement costs. And then in some cases, if we have servicing costs, these costs will be expensed. So not all subsequent costs get capitalized. We need to distinguish between those that we capitalize, like improvements, and those for servicing. Okay, someone is saying I'm breaking up. My internet connection seems to be stable. Maybe it's on your side, but we are recording, so you can always watch the recording afterwards. Okay, then we need to have a look at derecognition. How do we account for items of PPE on disposal, or when there are no future economic benefits expected from its use? We are also going to look today at a change in estimates. How do we account for a change in estimate of PPE? And we're only going to look at the reallocation method. Then we're going to look at presentation and disclosure, how to present and disclose PPE in the statement of comprehensive income, statement of financial position, and the notes to the financial statements. Okay. So that is where we are going with this topic. Let's have a look at those items that are out of scope. So if you read it in your textbook, in your Grip and Garb textbook, these topics are out of scope. So if you look at Chapter 7, Section 3, items acquired via a government grant, we are not concerned with that for the purposes of this module. Future costs caused or increased over time. So that is also scoped out. And then Chapter 7, Section 4, the cumulative catch-up method. So that is for the change in estimate. So that is scoped out, but you must know the reallocation method. So what we do today will be the reallocation method. Then Chapter 7, Section 6, deferred tax consequences. That is also scoped out. And Chapter 7, Section 7, further encourage disclosure and disclosure regarding fair value measurements, that is also scoped out. Okay, so let's have a look at subsequent expenditure. So after initial costs, there are going to be additional costs that may be incurred relating to the item of PPE. So if there are subsequent costs, if they occur subsequently, then it makes sense that we call these costs subsequent costs. So these subsequent costs include things like day-to-day servicing, improvement costs, replacement of parts, and major inspections. So subsequent costs are going to be added to the asset or capitalized if they meet the recognition criteria. So they must meet the recognition criteria. So remember, the recognition criteria per IAS 16 is that the cost is reliably measurable and will lead to probable future economic benefits. If the recognition criteria is not met, then these costs are going to be expensed. Okay, so subsequent expenditure is not automatically capitalized. We need to make sure that the subsequent cost meets the recognition criteria. If not, the cost is going to be expensed. So we also need to look at day-to-day servicing costs. So this is part of subsequent expenditure. These costs include, but are not limited to, maintenance costs, service costs, labor, consumables, and small parts. So the purpose of these expenditures is often for repairs and maintenance to make sure that the asset continues to operate. So these costs are always going to be expensed in the statement of profit or loss, even if they are material in amount. So think back to the practical question that you did for part 1. In the initial cost, we had a repair, and we had to decide whether to capitalize that repair or to expense it. And we ended up expensing it because it was part of the normal day-to-day repairs. So these costs are always going to be expensed in the statement of profit or loss, even if they are material in amount. So the journal entry to expense these items are going to be debit, maintenance expense, or servicing costs. And this is an expense shown in the statement of profit or loss. And we are going to credit bank or payable depending on how the cost was paid for. Okay, so just remember that day-to-day servicing costs are always going to be expensed. And this is the journal for them. Then we need to look at improvement costs. So these costs are referred to as capital expenditure because they increase the value of an asset and the useful life of an asset. So there will be increases to the future economic benefits associated with the assets by decreasing the running costs, or there could be an increase in the units produced, like better efficiency. There could also be an improvement in the quality of goods being produced or services being provided. So if there's going to be an increase in the future economic benefits, then it makes sense that these costs are going to be capitalized to the cost of the asset. So obviously the recognition criteria needs to be met here. So once capitalized, the revised cost or carrying amounts must be used to calculate the depreciation expense in subsequent accounting periods. So where we have an improvement cost and it results in a capitalization, the journal for that is going to be debit asset cost. And remember, you have to show that the asset is an asset. So if the asset is a vehicle, you'll say debit vehicle cost, and then in brackets, you'll show statement of financial position assets. Then credit bank payable, depending how this PPE item was purchased. Okay, so just remember those journal entries because you will be asked journals for PPE at some stage. Okay, so let's have a look at when we have a capitalization of a new part. So if the property, plant and equipment definition and recognition criteria given in IAS 16 are met, the cost of the replacement part must be recognized as an asset. If the cost of this new part is significant in relation to the value of the asset as a whole and has a useful life and method of depreciation that is different to the rest of the assets, then this new part must be recorded in a separate asset account. However, if we have immaterial replacement parts, these should be expensed as day-to-day servicing. So this would be something like a car where we have an engine. We could actually replace that engine and it would have a separate useful life to other parts in the vehicle. So let's have a look at an example here for replacement of a part. We have Small Limited, and they own a car that had a carrying amount of 30,000 on 1 January 2019. Details of this car recorded as two significant parts were as follows on 1 Jan 2019. So we have the car structure with 20,000 with a remaining useful life of 10 years and a nil residual value. And then we have the car engine for 10,000 Rand with a remaining useful life of 2 years and a nil residual value. So both of those values, the 20,000 and the 10,000, that adds up to the carrying amount of 30,000. But you can see that they have different useful lives. So the old engine, which had an original cost of 12,000, was scrapped and replaced on 1 October 2019 at a cost of 15,000 Rand. The new engine has a useful life of 3 years and a nil residual value. The straight line method is used. So show the journal entries relating to the purchase of the new engine in 2019. So the first thing we need to do is to make sure that we have depreciated the old engine before we replace it. So here we're going to take the value of the old engine being 10,000 Rand, and they told us in the scenario that there was a nil residual value and a remaining useful life of 2 years. So we are going to depreciate the old engine first up to the date where we replaced it. So we're taking the value of the engine, which is 10,000 Rand, minus the residual value of 0, divided by the useful life, the remaining useful life given in the question of 2 years. And then because the engine was replaced on 1 October 2019, we are going to prorate the depreciation. So we're going to count from January all the way to 1 October. So if you count, that will be 9 months. So we're multiplying by 9 over 12. And that is going to give depreciation of 3,750 Rand relating to the old engine. So we debit depreciation vehicle and we credit vehicle engine accumulated depreciation. So we are simply depreciating the vehicle's engine up to the date of replacement. So on the 1st October 2019, now we need to impair the vehicle's engine. So it told us that the old engine was scrapped and replaced. So we need to impair this engine before we can record the new engine. So we are going to take the carrying amount of the engine on the date of replacement. So we are going to say, so the carrying amount on 1 Jan 2019 was 10,000 Rand, but we had further depreciation that we processed up to 1 October 2019. So we want the carrying amount at the date of replacement. So we take the 10,000 Rand minus the depreciation of 3,750 relating to the 9 months, and that is going to give us a carrying amount of 6,250 Rand. So now we need to impair this amount because they told us that the old engine was scrapped. It obviously damaged or stopped working. So we're going to debit impairment loss of vehicles. And remember, an impairment is an expense shown in the statement of profit or loss. And we're going to credit vehicle engine accumulated impairment losses with 6,250. So here we are simply impairing the vehicle's engine on the date of replacement and derecognition. So now we depreciated the old engine and we've impaired it. Now we need to strip it out and derecognize the old engine from our financial statements. So here we need to so because the cost was debited when we bought the engine, now we need to credit the cost. And remember, when we did accumulated depreciation, we debited the accumulated depreciation. We credited the accumulated depreciation account. So now we need to strip that out, and we do that by debiting the accumulated depreciation and impairment accounts. So here you'll see they split the accumulated depreciation from the accumulated impairment loss account. You can show these separately or together. So we are debiting vehicle engine accumulated depreciation with the depreciation to date. So remember, in the prior year, we would have had 2,000 Rand worth of accumulated depreciation. If we compare the cost, the original cost, to the carrying amounts on 1 Jan 2019. Then we're going to take that 2,000 Rand worth of depreciation plus the depreciation for the current year of 3,750. So that is going to give me 5,750 Rand. That is the total accumulated depreciation relating to this old engine. And we are reversing this. We are taking this out of the records because we are derecognizing the old engine. So we want the cost and all the accumulated depreciation and impairment losses relating to the old engine to be taken out of our financial records. Then we do the same with the accumulated impairment accounts. So when we impaired the asset, it resulted in an impairment loss of 6,250 Rand. So we now need to strip that out of the account or take that out of our records because we're no longer going to own this engine. So we credited the accumulated impairment loss account when we had the impairment. So now we are debiting the vehicle engine accumulated impairment loss account. We are simply taking the accumulated impairment loss and we are taking it out of our financial records. Then we need to remove the cost from our records. So they told us in the scenario that the original cost was 12,000 Rand. So that is the cost we are going to reverse. So we are crediting the vehicle cost with 12,000 Rand, and we are basically derecognizing the old engine. We cannot record the new engine until we derecognize the old engine because we are replacing that part. So once we have derecognized the old engine, now we need to show the purchase of the new engine. And they told us in the scenario that the new engine on 1 October 2019 cost 15,000 Rand, and it has a useful life of 3 years and a nil residual value, and the straight line method is used. So now we're going to record the new engine, and then we're going to depreciate the new engine up to the year end, which is 31 December 2019. So we're going to debit vehicle engine cost. This is an asset. This is the new engine, and it costs 15,000 Rand. And we're going to credit bank/trade payables. They didn't specify in the question how the engine was paid for. So this is the purchase of the new engine. We derecognize the old engine. Now we are showing the new engine that has been purchased. On 31 December 2019, we are going to depreciate the new engine. So we had the new engine from 1 October 2019. So if we count that, that is 3 months. We're counting October, November, December. So we're going to debit depreciation with the amount of the depreciation, but let's work it out first. So they told us that the cost of the new engine was 15,000 Rand, and the residual value is 0, divided by a useful life of 3 years. And then because we only had the engine from 1 October, we are going to depreciate for 3 months out of the 12 months. And that is going to give us an accumulated depreciation of 1,250 Rand. Then we also need to depreciate the rest of the structure of the vehicle. So remember, the car structure doesn't just consist of the engine, it also consists of the structure. So we need to depreciate the structure for the year. So the value of the structure was 20,000, and it had a remaining useful life of 10 years and a nil residual value. So we need to also process depreciation on the car structure. So we are depreciating the structure for the full year because it was available for the full year. So we're going to take the 20,000 Rand minus the residual value of 0, divided by the remaining useful life of 10 years, and that gives us 2,000 Rand worth of depreciation for the full year. So when we add up, so we're going to go credit vehicle structure, accumulated depreciation, and we've already got the accumulated depreciation for the engine. So you can see we've provided the accumulated depreciation separately. And then we're going to debit depreciation vehicle, which is an expense in the statement of profit or loss, with the sum of the depreciation for the current year. So if we add up the depreciation relating to the new engine for the 3 months, it is 1,250 Rand, and the accumulated depreciation for the structure is 2,000 Rand. That will give us total current year depreciation at 31 December 2019 of 3,250 Rand. Okay, so that is how we deal with the replacement of a part. We need to make sure we have fully depreciated the old part and derecognized it from our financial records before we can record the new part. Then we need to look at something called major inspections. So some assets require a regular major inspection. So these will be assets like ships and aeroplanes. So these inspections must be recognized as an asset. So when an asset requires a regular major inspection as a condition of its continued use, it's important that this cost be capitalized as soon as either the cost is incurred or an obligation arises. So the major inspection is going to be recorded as an asset, and then it's going to be depreciated over the period until the date of the next inspection. So if the cost of the inspection asset is significant and the rate and method of depreciation of the inspection differs from that of the other parts, then the cost of the inspection is going to be recognized as a separate part. So often the inspection will need to be performed every 2 years or 3 years on a ship or an aeroplane, but the useful life of the ship or aeroplane could be like 10 or 20 years. So then it makes sense that the inspection asset is recorded separately. So let's have a look at an example here of a major inspection performed. So new legislation was promulgated on 1 September 2019, whereby all public transport buses are required to undergo a regular major inspection every 2 years. Good Limited owns a bus that has a carrying amount of 80,000 as at 1 Jan 2019. A major inspection of this bus was performed on 1 October 2019 at a cost of 20,000 Rand. This bus is depreciated on a straight line method to a nil residual value over its remaining useful life of 10 years, calculated from 1 Jan 2019. Show the journal entry relating to the major inspection. Okay, so let's have a look at the major inspection. So they told us that the major inspection was performed on 1 October 2019 at a cost of 20,000 Rand. So we need to record the major inspection that was performed on this date. So we are going to debit bus major inspection, and then the cost of the inspection was 20,000. So you can see we're recording the bus major inspection as an asset, and we are crediting back with 20,000 Rand. So we are recording the major inspection as an asset on 1 October 2019. Now we need to depreciate the inspection and the rest of the bus. So let's start with the bus accumulated depreciation. So they told us that the bus is depreciated on a straight line method to a nil residual value over its remaining useful life of 10 years. And the bus had a carrying amount of 80,000 Rand. So we're going to say 80,000 Rand, that is the value of the bus, minus the residual value of 0, divided by the useful life of 10 years, and we are depreciating the bus for the full year, because even though the inspection was performed part way, we own the bus for the full year. So we can multiply it by 1 year, and that will give us a bus accumulated depreciation of 8,000 Rand. Now we also need to depreciate the major inspection. So the major inspection cost 20,000 Rand. So that is the value of the asset we are going to depreciate. And the inspection is required to be done every 2 years. So we are going to take 20,000 Rand divided by 2 years. And remember, the inspection was only done on 1 October 2019. So we're going to count October, November, December. So that is for 3 months. So we're going to multiply by 3 over 12. And that is going to give us the accumulated depreciation of 2,500 Rand. That is the accumulated depreciation relating to the bus major inspection. So then we have the accumulated depreciation for the bus and the accumulated depreciation for the major inspection. So we're going to debit depreciation bus with the total of the depreciation for the different parts. And that is going to give us total depreciation for the 2019 year of 10,500 Rand. Okay. So let's just think about this as well. So why is the inspection recognized on 1 October 2019 and not 1 September 2019. So it told us that new legislation was promulgated on 1 September 2019. So even though the law was passed on 1 September 2019, when this law is enacted, it does not create an obligation for Good Limited, since Good Limited could simply decide to drive the buses without the inspection. So the obligation only arises when the inspection is performed. So the major inspection has a useful life, which is different to that of the physical bus. So just note, remember we said that the useful life of the inspection is 2 years, after which a new inspection will have to be performed. And then because the inspection occurred 3 months before year end, that is why we depreciated it for 3 months instead of the full year. Okay, so that is how to account for a major inspection. And you'll see that this will be in some of your tutorial and your practical questions. Okay, so there's a question here, why do we use the carrying amount to depreciate the bus? Okay, so they have given us the carrying amount of the bus of 80,000 and then the remaining useful life of 10 years. That's all they've given us in the question, so that's what we have to use. Because they've given us the remaining useful life as well, instead of the total useful life, it makes sense to depreciate the carrying amount. Okay. Now let's have a look at where we have a situation where a major inspection is purchased as part of the assets. So if an entity buys an asset that on the date of purchase has already been inspected and does not require another inspection for a period of time, the cost must be separated into the cost that relates to the physical assets or its separate significant parts, and the cost that relates to the balance of the major inspection purchased. So the cost of the inspection need not be separately identified on the sale documentation. An estimate of the cost of the inspection can be made based on the expected cost of future inspections. Okay, so let's have a look at an example where we have a major inspection purchased as part of the assets. So a ship may only be used if it is inspected for faults every 3 years. The 2020 inspection was done on the 31 December 2020 and is included in the purchase price, although the exact cost thereof is not known. The next inspection is due on 31 December 2023. The expected cost of this future inspection is 400,000 Rand, and the present value thereof is 300,000 Rand, discounted to 1 Jan 2021. Show how this would be journalized in 2021. Okay, so here we have the ship, and they told us that it was purchased for 1.3 million, and we are going to split the ship structure cost with the ship inspection cost. So you can see that they are recording the ship structure separately from the major inspection. So let's have a look at the ship major inspection first. So the ship major inspection, we used an estimate of the 300,000 Rand, and we discounted it to 1 Jan 2021. Okay, so they told us that the 2020 inspection that was done, the exact cost was not known. So we are using an estimated cost of a future inspection. But the future inspection of 400,000 Rand, this is going to happen in the future. So we cannot use that value of 400,000 Rand because of the time value of money. So we need to present value that 400,000 Rand to today's terms of 1 January 2021. So the present value of the inspection at the date we are recording this asset is 300,000 Rand. So that is the amount that we are going to use to record the ship major inspection. So we're going to debit ship major inspection cost with the present value of the 2023 inspection cost of 300,000 Rand. And then we're going to record the rest of the ship. But we have recorded the inspection separately. So we're going to debit ship structure cost, and the rest of the ship can be calculated by taking the 1.3 million minus the 300,000 present value of inspection costs, and this will give the ship structure cost of 1 million. So we're debiting the ship structure cost with 1 million, and we're debiting the major inspection separately. So we're debiting ship major inspection cost with 300,000. This is the estimated cost, and we are crediting back. So this is the purchase of the ship. The 2020 inspection cost is measured based on the present value of the estimated 2023 cost. On 31 December 2021, we need to provide for depreciation on the ship. But we're going to depreciate these two parts separately because the inspection has a different useful life to the structure. So we are going to have a look at the structure first. And the structure cost was 1 million and the residual value was 0. And they told us in the question that the useful life is 10 years. So we're going to take the 1 million ship structure divided by the useful life of 10 years, and we're depreciating for the whole year. So we get ship structure depreciation of 100,000 Rand. Then when we look at the ship major inspection, that had a different useful life to the rest of the ship. The ship inspection needs to be performed every 3 years. So that is the useful life of the inspection. So we are going to then depreciate the ship major inspection over 3 years. So we're going to go 300,000 Rand divided by 3 years, and that is going to give us 100,000 Rand. So we can add the accumulated depreciation for the ship structure and the major inspection, and we're going to go debit depreciation ship 200,000 Rand. But remember that these items, because they have a different useful life, they must be depreciated according to their relevant useful lives separately. So now we have depreciated the ship structure. So why are we not recording the 2023 inspection? So the question said the next inspection is due on 31 December 2023. So why are we not recording the future inspection? And the reason is that we are in the 2021 year. The 2023 inspection is not recognized at 31 December 2021 as no obligation exists for it in 2021. So there's been no past event that's occurred. However, we are just using the expected 2023 inspection cost to estimate the value of the 2020 inspection that has already been performed. So we are just using the estimated cost of the 2023 inspection to work out the value of the inspection asset that we already have. Okay. So that is how we count for a major inspection when it is purchased as part of an asset. Now we need to have a look at derecognition. So when do we derecognize an item of PPE? So an item of property, plant, and equipment must be derecognized when it no longer meets the definition of an asset and the recognition criteria. Okay, so don't forget about the recognition criteria. So when an item no longer meets the definition of the PPE asset definition and the recognition criteria, it must be derecognized. This will happen on disposal or when no future economic benefits are expected from its use. So perhaps it is fully depreciated, then no future economic benefits are expected, then we will need to de-recognize it. So a disposal occurs if an asset is sold, destroyed, donated, scrapped, or permanently withdrawn from use. So derecognition means to remove the item from the accounting records. So we need to remove all those items that relate to the PPE that we are derecognizing. So when to derecognize PPE, so we said this will happen on disposal or when no future economic benefits are expected. When we have a disposal, there will be usually a gain or a loss on the disposal. And this is calculated by taking the net disposal proceeds minus the carrying amount. So how do we de-recognize an item of property, plant, and equipment? So we are going to remove the carrying amount from the accounting records, meaning we're going to remove all the related accounts. So think about the cost when we originally purchased this asset, the accumulated depreciation and accumulated impairment losses, or the carrying amount if the cost is not given, okay? So whatever relates to this PPE item that we recorded in our financial statements, these all need to be removed when the asset is derecognized. So that is step one. Remove the carrying amount from the accounting records and all the things making up the carrying amount, like the cost and accumulated depreciation and impairment losses. Step two would be to determine and recognize the proceeds on disposal. So we need to determine, is anything paid for this item we are disposing of? And then this needs to be measured and reported, okay? It is not going to be shown as revenue because revenue, that indicates that it's like the normal part of your operations, but a proceed on disposal is not revenue, okay? So once we have removed the carrying amount from the accounting records and we determined and recognized the proceeds on disposal, then we are going to do an offset. So the carrying amounts, we're going to set off the carrying amounts and the income against each other. And then the process of setting off the carrying amount of the asset and the proceeds against the carrying amount, this is going to result in something called profit or loss on disposal, okay? So we'll get a profit or loss, and we do this in an account called the profit or loss on disposal account. So in this account, and I'll show you just now, this will help us determine if there's a gain. This gain may not be classified as revenue. It's simply going to be income and profit or loss. Or if we have a loss on disposal, which would be an expense recorded in the statement of comprehensive income. So the disposal is going to be recognized when the risks and rewards of ownership pass from the seller to the buyer. Okay. So let's just summarize what's going to happen. We need to calculate the carrying value on the date of the sale. And then the cost of the asset needs to be derecognized. And this is going to happen by crediting the cost. Previously, we would have debited the cost when we recorded the asset on acquisition. So now we are removing the cost from our financial statements, and we do that by crediting the cost. Any accumulated depreciation relating to the asset must be eliminated. So previously, we would have credited the accumulated depreciation accounts. Now we're going to eliminate the accumulated depreciation by debiting the account. And it's the same with the impairment. If we had accumulated impairments for this asset, we would have credited that account, but now we are removing the accumulated impairments, so we are debiting the account. Then we're going to determine any profit or loss on disposal that must be recognized. And remember, the profit or loss is going to be recognized in the statement of comprehensive income. Let's have a look at some of the journal entries relating to the derecognition. So this would be an asset disposal journal entry. So you can see we are recording the proceeds, we are debiting back. Obviously, they paid us cash for this asset we are disposing of. So we're debiting bank and we are debiting accumulated depreciation. We are stripping out the accumulated depreciation relating to the assets. Then we are going to credit the PPE cost. We are removing the cost from our financial statements. And then depending on what the proceeds are and what the carrying amount is, we will either get a loss on disposal or a gain on disposal. So we will have a loss if the proceeds from disposal are less than the carrying amount of the asset at the date of disposal. However, we'll have a gain if the opposite is true. We'll have a gain if the proceeds from disposal are greater than the carrying amount of the asset at the date of disposal. So this shows the journal entry, but let's have a look at the asset disposal ledger on the next slide. So if we have a situation, a disposal which results in a loss, our asset disposal account is going to be the first one. So here you can see that we are debiting the asset disposal account with the cost of the asset, and we are crediting the asset disposal account with the accumulated depreciation and the bank. And then in this scenario, the carrying amount is greater than the proceeds, so we have a loss on disposal. And this loss on disposal is credited in the asset disposal account, and it's an expense. Then if we have an asset disposal account in a scenario where there's a gain, this is what the asset disposal account shows. So we're going to have debit asset cost, and we're going to credit the asset disposal with accumulated depreciation and bank. And then here, if we have a gain, it means the proceeds we are getting for this asset on disposal is greater than the carrying amount. So we will have debit profit on disposal. So this is what the asset disposal general ledger account shows. I'm quite certain you've seen this in prior years, maybe first year or even last year. So let's look at an example where we have a derecognition of an asset. We have Entity Limited, and they acquired a computer on 1 July 2017 at a cost price of 100,000 Rand. At acquisition, the computer had an estimated useful life of 5 years and a residual value of 0. The company depreciates the computer on a straight line basis. On 31 March 2020, the computer was sold and the entity made a profit of 15,000 Rand. Assuming the year end is 30 June, calculate the missing amounts denoted by A to C. So here we are given the cost of the asset, which is 100,000 Rand. And you can see that we have credited the cost. We are derecognizing the cost, and we have a profit on disposal of the asset of 15,000 Rand. So we want to know if we can use these figures we have been given, the cost and the profit, to work out what the other amounts are. What is the bank and what is the accumulated depreciation? So here, let's see what we can work out. So we were told that the cost is 100,000 Rand and the residual value is 0. The depreciable amount is 100,000 Rand and the useful life is 5 years. And we were told that the depreciation method is straight line. So we want to work out what is the annual depreciation. So to work out the annual depreciation, we're going to take the cost of 100,000 Rand divided by 5 years, and this is going to give us the annual depreciation of 20,000. Then how many years are we depreciating this asset for? So we're depreciating this asset for 2 full years and then the last 9 months. So from 1 July 2017 to 30 June 2018, which is 12 months, the depreciation was 20,000. And for the following year, from 1st of July 2018 to 30 June 2019, we depreciated this asset for another 12 months. Then in the current year, from 1 July 2019 to 31 March 2020, that was 9 months. So we apportioned the 20,000 depreciation by multiplying by 9/12, and that gives us accumulated depreciation of 15,000. So that is going to give us total accumulated depreciation relating to this asset of 55,000. So we want to know, can we work out the carrying value? We were told the cost, and now we have the accumulated depreciation. So we can work out what the carrying value is by taking the cost of 100,000 minus the accumulated depreciation of 55,000, and that is going to give us a carrying amount of 45,000 Rand. So we've worked out what the carrying amount is. So you can see in this scenario, you are not given proceeds, but profit made on the disposal. So now we can use the profit on disposal to calculate the proceeds. So we worked out what the carrying amount was. So we know that the gain or loss is going to be calculated by taking the proceeds minus the carrying amount. So we were told there was a gain of 15,000 Rand, and we are trying to work out what is the proceeds paid. We worked out what the carrying amount was in step 1. The carrying amount was 45,000 Rand. So if we rearrange this equation to work out the proceeds, we can see that the proceeds can be calculated by taking the gain of 15,000 Rand plus the carrying amount of 45,000 Rand. So that will give us proceeds of 60,000 Rand. So now we have worked out the proceeds. Now we can complete the missing numbers. So here in our journals, we are debiting bank with 60,000. That was the proceeds we just calculated. Then we are debiting the accumulated depreciation account. We are stripping out the accumulated depreciation relating to the computer on disposal. Okay, we didn't have a loss, so we ignore that line item. The original cost of the asset must be credited. So the computer originally cost 100,000 Rand. So we are crediting the computer cost with 100,000 Rand. We are removing the cost from the accounting records. And then we have a profit on disposal of the asset of 15,000 Rand. So this shows now all of the missing numbers we had for the assets. So we were able to use the profit and the carrying amount to work out the accumulated depreciation and the proceeds on disposal. Okay. So while the asset disposal slides, it shouldn't really be new to you. We are now going to look at a change in estimates, and this is probably something that is new for all you guys. Okay, so you need to pay attention to this because it will be tested in your tests and exams. So when we have an item of PPE, so the measure of that item is reflected in its carrying amount, and it's made up by its initial measurements and subsequent measurements. So subsequent measurement will involve using the cost or revaluation model, the depreciation, and any impairments. Okay, so the depreciation reflects the usage of the asset, while the impairment reflects any damage to the asset. So under the cost model requires an asset to be recorded at cost, less accumulated depreciation and accumulated impairments. So no adjustments are made for increases in the value of the asset. So the residual value, the estimated useful life, and the depreciation method, these must be reassessed at least annually because these things could actually change. So any of these estimates may be changed during the depreciation period. So if there is an adjustment to any of these estimates, this is going to be made prospectively in the current and all future periods looking forward. Okay. So let's just recap on depreciation. When to begin depreciating? So remember we learned last week that depreciation starts when the asset is available for use. In other words, when the asset is in the location and condition necessary for it to operate in the manner intended by management. When do we stop depreciating? So depreciation will stop when the asset is sold, scrapped, permanently removed from use. It could be reclassified as available for sale. It could be fully depreciated. In other words, the net book value or carrying amount will equal the residual value. So depreciation does not stop if the asset is temporarily removed for use or undergoing repairs. So the debit for depreciation, this is going to be determined based on certain estimates. So there's going to be an estimated pattern of usage of the assets over time. There's going to be an estimated residual value of an asset and an estimated remaining useful life of the assets and an estimated production capacity if applicable. Okay. So what is the maximum possible output? So that is the estimated production capacity. So remember that depreciation is worked out by taking the cost minus the residual value divided by the useful life. So these items cannot always be precisely measured. So we are often required to make estimates for things like the useful life. So the useful life, it may change as time goes on, meaning that the estimate changes. If an entity decides that any one of the three variables of depreciation needs to be changed, it needs to be adjusted and accounted for as a change in accounting estimates. So this will be governed by the IAS 8 accounting policies, errors and estimates standard. There are two methods that can be used to calculate the revised depreciation when there is a change in estimate. So the reallocation method and the cumulative catch-up method. So we are only going to focus on the reallocation method. The cumulative catch-up method is scoped out. So the method we are learning today is the reallocation method. So under the reallocation method, no adjustment is made in the current year for the effect of the change in the prior year. The recalculated depreciation expense is going to be used for the current period and all future periods, or until there is another change in any of the estimated variables. So the simplest way to think of this is as if it was a new asset, okay? And to use the asset's carrying value as the new cost and to depreciate it using the new residual value over the remaining useful life based on the new method of depreciation. So remember, similar to how we had the impairment loss reversal or the impairment loss in our practical question, and the carrying amount after the impairment then became the new cost, and we were depreciating over the remaining useful life. So it's a similar scenario here. So after the change in estimates, then the asset's carrying value is going to be used as the new cost for depreciation. And then we're going to depreciate the asset over the remaining useful life, okay, based on the new method of depreciation, which is the change in estimates. So for example, the opening carrying amount of plants calculated based on the previous estimate It's simply going to be reallocated over the remaining revised estimated useful life. Okay, so that carrying amount, it's going to be reallocated using the new useful life or residual value. So let's have a look at an example here. So we have a machinery was purchased on 1 January 20x7, on which date it had an estimated useful life of 5 years and a nil residual value. So the carrying amount on 31 December 20x8 was 300,000. Then it shows us that the original cost on 1 Jan 20x7 was 500,000, and then there was depreciation for 2 years of 200,000. So this is what they're giving us. And the net carrying amount on 31 December 2008 was 300,000. They've told us on 1 January 20x9, the total economic useful life was re-estimated to be 4 years. So now we need to use the reallocation method and work out what is the effect of the change in useful life on the depreciation. So the first part says, show the journals assuming that the 20x9 depreciation journal had not been processed. And then part 2 says, show all depreciation journals that would be processed in 20x9, assuming that the 20x9 depreciation journal had already been processed, i.e. before the change in estimates. So in this scenario, we can clearly see the useful life has changed. So there has been a change in useful life, meaning that is the change in estimates. So this means that the depreciation expense for the current and all future periods has to be recalculated. So step 1, calculate the carrying value at the beginning of the current period. So in the question, the carrying value was given to us on 1 Jan 20x9 as 300,000, and the total useful life was re-estimated to be 4 years on that date. Okay, so the first step, calculate the carrying value. It is actually given to us as 300,000 Rand in the question. Okay, so here, this is the 300,000 Rand carrying amount. This is the date that the total economic useful life was re-estimated. So we have the carrying amount at the beginning of the current period, it was 300,000, and the total useful life was re-estimated to be 4 years. Previously, the total useful life was 5 years, but now the total economic useful life is re-estimated to be 4 years, okay? But when we apply the new estimate, so the new estimate in this case needs to be applied over the remaining useful life. So the total economic useful life is re-estimated to be 4 years, but we cannot use the total economic useful life when working out the new depreciation because 2 years have already passed. Remember, we depreciated the assets for the 2 years. That 200,000 Rand represents depreciation for 20x7 and 20x8. So that is 2 years worth of depreciation. So we cannot use the total economic useful life of 4 years as 2 years have already passed. So we need to work out what is the remaining useful life. So we take the total useful life of 4 years minus the 2 years that have already passed, and that is going to give us a remaining useful life of 2 years. So the depreciation for 20x9 is 300,000 divided by 2 years, and that will give us an amount of a depreciation for 20x9 of 150,000 Rand, okay? So based on the change in useful life, our depreciation for 20x9 is going to be 150,000. Now remember it said part 1, what is the depreciation, assuming that the accountant had not processed the depreciation yet. So if the accountant realized that he needed to change the estimate before he had processed the 20x9 depreciation, the 20x9 depreciation journal would be as follows. So we would debit the depreciation expense account, and the depreciation based on the new estimated useful life is 150,000. And then we are crediting machine accumulated depreciation with 150,000. Depreciation using the total useful life of 4 years. So this is based on the new estimate. The accountant decided, knew that the useful life was changing. So this is the depreciation journals. Now, if we have depreciation journals in 20x9, depreciation had already been processed by the accountant using the old method based on the old estimates. We then will need to see what the new depreciation is based on the new estimates and record the difference. Okay, so I see someone says they can't see the PowerPoint screen, but I've joined with 2 devices and I can see it on both. So I think the problem might be on your side. So the accountant in part 2, they recorded the depreciation using the old estimate. So they took the 500,000 Rand minus the residual value of 0 divided by the old estimated useful life of 5 years. And they got depreciation of 100,000. So we are debiting depreciation with 100,000, and the accountant then credited the machinery accumulated depreciation with 100,000. So this is based on the old estimates. However, based on the new estimate, the depreciation should be 150,000, but the accountant has only recorded 100,000. So based on the new estimate, we need to record a further depreciation journal of 50,000 Rand, which is the difference between what the accountant has already processed and what the depreciation should be now. So the accountant will then process a further journal to depreciation of 50,000 Rand, and the accountant will say debit depreciation 50,000 Rand, credit machinery accumulated depreciation with 50,000 Rand, and they'll say that the journal was processed based on the old total useful life of 5 years, but now we have a change in estimate and we are processing a further 50,000 Rand. Okay, so you can see the difference here between part 1 if the accountant had not processed the journal, and then part 2 if they had already processed based on the old estimates, they would need to process a further 50,000 Rand. But the net effect, if you add up the 2 journals in part 2, it's the same amounts as the accountant processed in part 1. Okay. So just have a look at this example here. And then let's have a look. So this example dealt with a change in useful life. Now this is going to, example 5 is going to deal with a change in estimated residual value using the reallocation method. So machinery was purchased on 1 January 20x7. On this date, it was estimated to have a useful life of 5 years and a nil residual value. So the carrying amount on 31 December 20x8. So these are the amounts given. The cost was given on 1 Jan 20x7 as 500,000, and the accumulated depreciation for the 2 years, for the 20x7 year and 20x8 year, was 200,000. The net carrying amount is therefore 300,000. Okay. They told us that there was a nil residual value for this asset. However, on 1 January 2009, the residual value is now re-estimated to be 90,000 Rand. So previously, from 1 Jan 20x7 to 31 December 20x8, depreciation was based on a null residual value. But now on 1st Jan 20x9, the residual value is re-estimated to be 90,000. So using the reallocation method, calculate the effect of the change in estimate. So that's part A. And then part B says show all 20x9 depreciation journals, assuming that depreciation had not yet been journalized. And then part C, show all 20x9 depreciation journals, assuming that depreciation had already been processed. So let's have a look at part A. So here we're going to work out what is the effects of the change in the estimates on the depreciation. So there has been a change in the residual value. So this means that the depreciation expense for the current and all future periods has to be recalculated. So the first step is to calculate the carrying value at the beginning of the current year. So in the question, the residual value was null, and the residual value is now re-estimated to be 90,000 Rand on the 1st of January 20x9. The carrying value is given at 300,000 Rand. So do you agree that carrying value there is the carrying value we are looking for? So the carrying value is going to be was given, and is 300,000 Rand. Now we need to apply the new estimate, the useful life, the residual value, the depreciation method over the remaining useful life. So remember, the total economic useful life at the beginning of this asset's life was 5 years. 2 years have already passed, so we are going to be depreciating the carrying amount now over the remaining useful life, which is 3 years. So we are now going to work out the depreciation for 20x9 using the carrying amount and the new residual value, and the residual value was the change in estimate. And we are depreciating this using the remaining useful life of 3 years. So the depreciation for 20x9 can be calculated by taking 300,000, which is the carrying amount, minus the residual value of 90,000 Rand, divided by 3 years, and that is going to give us 70,000 Rand. So this 70,000 Rand now, this is the depreciation for the 20x9 year. So now we want to report the depreciation. The accountant realized that he needed to change the estimated residual value before he processed the 20x9 depreciation. So the 20x9 depreciation journal is now going to be debit depreciation with 70,000 and credit machinery accumulated depreciation with 70,000. So this is showing the depreciation in the current year based on the new estimated residual value. The accountant knew that the residual value was changing, so this is the only journal he processed, okay, which is correct. However, if we have a situation where the accountant already processed the depreciation using the previous residual value, when we then need to look at the journal that's processed to update the depreciation to what it should be using the new residual value. So if the accountant had already processed the depreciation for 20x9 based on the old residual value, he would have calculated it by saying 500,000 Rand minus the null residual value divided by the total useful life of 5 years. And that will give us 100,000 Rand. So he would have debited depreciation with 100,000 Rand and credited machinery accumulated depreciation with 100,000 Rand. So this would have been the accountant journalizing the depreciation based on the old useful life. Now the accountant realizes that the residual value has changed and it is no longer 0. The residual value is now changed to 90,000 Rand. So now depreciation should have been 70,000 Rand, but the accountant has already processed 100,000 Rand. So now the accountant realizes that too much depreciation was recorded, and now they need to reverse some of the depreciation. So now the accountant wants the net effect to be depreciation recorded of 70,000 Rand. So the accountant is now going to process this journal to reduce the depreciation that was processed. The accountant recorded 100,000 Rand worth of depreciation based on the old residual value, but it should be 70,000. So the accountant is going to say debit machinery accumulated depreciation with 30,000 and credit depreciation with 30,000. So the effect of this is that the accountant recorded too much, and this journal of 30,000 is simply reducing the depreciation that was recorded. So the net effect of these two journals here is the same. It results in 70,000 Rand being processed. So this example shows the difference when the accountant here knows about the change in estimates and records the new depreciation based on the new residual value. And here the accountant did not know that there was a change in estimates. So he recorded the depreciation based on the old estimates and now realizes that too much depreciation was processed. Okay, so that is how we account for a change in estimates. We have looked at how to account for a change in estimate where the useful life changes and where the residual value changes. Now let's have a look at presentation and disclosure. So when we present and disclose PPE, this involves all financial statements. It involves the statement of financial position, the statement of comprehensive income, the cash flow statement, and the statement of changes in equity. It also involves the notes to the financial statements. So the property, plant, and equipment reconciliation notes, the accounting policy notes, and the profit before tax notes, if profit or loss section is prepared and analyzed by function. Okay, so these are all the elements that PPE involves in the financial statements. So here we have an example of a statement of financial position. So property, plant, and equipment must be shown as a single line item on the face of the statement of financial position. So you can see here that we have a heading for the company, XYZ Limited, statement of financial position. So this is just an extract of the statement of financial position. It's not the whole statement. So we'll see that the property, plant, and equipment line item is shown under assets, and it is a non-current asset. And even though it's shown as a line item here, it is going to be referenced to the property, plant, and equipment reconciliation note. So this line item here, it must be supported by the property, plant, and equipment reconciliation note. So this note reconciles the opening and closing balances of the gross carrying amount and the accumulated depreciation. So remember that property, plant, and equipment note we covered in your practical, the one with the opening balances and the movements for the year and the closing balances. This is the note that must be referenced when we look at the property, plant, and equipment note as a line item. So let's have a look at the property, plant and equipment reconciliation note on the next slide. So here we have the PPE reconciliation note, and we have the opening balances here, which consist of the cost price and the accumulated depreciation. And this gives us the carrying amounts at the beginning of the year. Then we have the movements during the year. So this would be things like acquisitions or additions, things like disposals and depreciation, also things like impairments. Then we have the carrying amount at the end of the year. So we'll have the cost price minus the accumulated depreciation, and that will give us the carrying amounts at the end of the year. So this is the PPE reconciliation note. You guys should all be familiar with it from prior years and also from last week's practical. So then we have the accounting policy note, which we also saw in the practical question. So here it just describes how property, plant and equipment is recorded, like what is the policy on how we determine the carrying amount for property, plant and equipment. So here it just says property, plant and equipment is shown at cost, less accumulated depreciation under the cost model. And it says that the company has a policy of not depreciating land. Depreciation is provided on all other property, plant and equipment over the expected economic useful life to their expected residual values. Depreciation is provided on the following assets using the following rates and methods. So plant is going to be depreciated on straight line over 10 years, and equipment is depreciated using the diminishing balance method using 20% fixed depreciation rate. So for each class of property, plants and equipment, like land and machines, the following must be disclosed. The depreciation method used, is it straight line? Is it diminishing balance? The useful lives or depreciation rates must be disclosed, and the measurement model. Is the cost model used or is the revaluation model used? So this all needs to be disclosed. Then in the statement of comprehensive income, there are various items like income and expenses relating to an item of PPE, which will affect the statement of comprehensive income. So these items will either decrease profit or increase profit. So those items that decrease profit, this is things like depreciation expense and your impairment losses. And then if you have any losses on disposals of PPE, these all decrease profit. Then we have those items that increase profit. These are things like reversals of impairments, and if we have a profit on disposal of PPE. Then let's have a look at presentation. So there are two ways that the profit or loss section of the statement of comprehensive income can be presented. So depreciation expense and other expenses can be presented differently on the face of the statement. So if the company uses the function method for the statement of comprehensive income, they are going to show the income and expenses on the face of the statement of comprehensive income and include them in one of the line items classified by function. So the expenses are going to be grouped together based on the function of the business where the expense occurs. So for example, they'll show the administration expenses, and the depreciation and the loss on disposal will be included under administration expenses. Then profit on disposal will be included under other income. So the nature of the amount of the separately disclosable income and expenses must then be disclosed in the notes to the statement. Okay. So we generally use the nature method. So this shows income and expenses presented separately by their nature on the face of the statement of comprehensive income. So total depreciation is going to be presented as a single line item. So we're going to take the sum of the depreciation expense for all the items of PPE, and we're going to show it as a single line item. Then we're also going to show the loss on sale of an item of PPE and the profit on sale of an item of PPE. The interest expense from the acquisition of an asset, so interest expense is also going to be shown, and it can relate to an asset if it is acquired with payment beyond normal credit terms. Then there could be a profit or loss on exchange of an asset. So all of these items are going to be presented separately based on their nature. So our focus is on income and expenses presented and analyzed by nature, not by function. But it's always good to know the function method in case you get to a company one day and that's the method they use. So here we have a disclosure example. We have a disclosure example using the cost model disclosure with impairments. So this just shows you how we disclose impairments and various other items relating to PPE. So plant with a cost of 100,000 was purchased on 1 Jan 20X1. There are no other items of property, plant, and equipment. The entity measures its plant under the cost model. It is depreciated at 25% per annum, straight line, to a nil residual value. The estimated recoverable amount at 31 December 20X2 is 55,000, and the estimated recoverable amount at 31 December 20X1 is 60,000. So disclose the above in the financial statements for the years ended 31 December 20X1 and 20X2, 20X3, and 20X4 in accordance with IFRS. Ignore deferred tax. Okay. So here we want to look at the disclosure. I have prepared the calculations. Unfortunately, they're not typed up, but I have prepared them here. So we can just have a look at them and then follow through with the disclosure. Okay. So if we look at this question here, they told us that the cost was 100,000 Rand. I will upload these workings onto Moodle, so you don't need to write it down. So the cost of the asset was 100,000 Rand, and it's depreciated at 25% per annum. So if we want the carrying amount on 31 December 20X1, because we need to compare the carrying amount to the recoverable amount they have given of 60,000 Rand. So the carrying amount will be worked out by taking the cost of 100,000 Rand minus the 25,000 Rand depreciation, and that will give a carrying amount of 75,000 Rand. So when the company compares the carrying amount of 75,000 Rand to the recoverable amount of 60,000 Rand, that will give an impairment of 15,000 Rand. So we have an impairment at 31 December 20X1. Then on 1 Jan 20X2, we need to continue depreciating this asset. And we learned that after an impairment, we can no longer depreciate the original cost, but we can depreciate the carrying amount, which is 60,000 Rand, divided by the remaining useful life, which is 3 years. And that will give us 20,000 Rand. So the carrying amount then becomes 40,000 Rand on the 31st of December 20X2. So the carrying amount of 40,000 Rand is then going to be compared to the recoverable amount of 55,000 Rand. And remember we said that when we have an impairment loss reversal, we must make sure that the recoverable amount is limited to the historical carrying amount. So the historical carrying amount is 50,000 Rand. So the recoverable amount is actually limited to 50,000 Rand. So then when we compare the carrying amount, we are comparing it to the recoverable amount, which is limited. And this then results in an impairment loss reversal of 10,000 Rand. So the historical carrying amount, that is calculated as if there's no impairment loss. So we calculate that by taking the 100,000 Rand minus the depreciation of 25,000 Rand for 20x1 and 25,000 Rand for 20x2. So that is how they calculated the historical carrying amount of 50,000 Rand. So after the impairment loss reversal, the asset then has a carrying amount of 50,000 Rand and a remaining useful life of 2 years. So then depreciation after the impairment loss reversal is going to be 25,000 Rand for 20x3 and 20x4. Okay, so those calculations will be uploaded, but they just help you when you have to disclose these items. So you can see in the statement of financial position here, they're showing the 4 years and they're showing the carrying amount of property, plant, and equipment. At 20x1, the carrying amount was 60,000, and then it just continues to show the carrying amount based on those calculations. You can see that this is referenced to note 4, and this is note 4 here. So this is just one big PPE note. They are disclosing the accounting policy at the top here. Then they have the opening balances from 20x1 to 20x4, and they have the movements for the year, and then they have the closing balances. So these numbers all come from that calculation that I showed you. Okay, but have a look at this because it is an important note. Then we have the profit before tax note. So this shows all of those items from property, plant, and equipment that affect the profit before tax. So things like depreciation, that's going to reduce the profit before tax, and the impairment loss as well. So we had the impairment loss in 20x1, and then we had an impairment loss reversed in 20x2. So this is just showing all of the items that are affecting the profit before tax in the statement of comprehensive income. Okay, so that is it, guys. This is just a recap. What did we do this week? We looked at subsequent costs and we looked at how to de-recognize an asset. And then we looked at how to do a change in estimate where we have a change in residual value and a change in useful life. And then we looked at presentation and disclosure. So that is it from me, guys. If you have any questions, you're welcome to type them in the chat box. If not, you're welcome to go. I'll be here for a few more minutes. So if you have any questions, you're welcome to ask. The recording will be uploaded after the session, and I still need to upload the practical from PPE part 1, which I'll do after this session. Thanks, guys.